My name is Sue Guan. I am the Albert J. Rufo Associate Professor of Law at Santa Clara University School of Law. I have been here for 5 years. This is my 6th year, and I teach contracts and a seminar on capital markets and financial misconduct. My research focuses on securities fraud and market manipulation, and I'm currently studying the role of social media in stock markets. Copy trading and the rise of the shadow intermediary really explores the promise and the perils of copy trading. Copy trading allows any investor to link their portfolio to that of an expert or that of a leader and automatically replicate those leaders' trades. So every time a leader buys or sells, so does the follower investor. And copy trading really makes, I think, a very tantalizing promise. Just link your portfolio to that of a leader or an expert and let that expert make all your investment decisions for you. But I think there are real dangers to this, and the paper ultimately argues that what's really happening is that copy trading has given rise to this army of shadow intermediaries, where these unregulated people are giving financial advice, performing portfolio management services without being regulated, or at least being significantly underregulated. And I chose to write this paper now because I think financial technology and fintech makes a lot of promises about improving our lives. And I think some of those promises bear out, but I think it's worth interrogating whether all of the promises really do deliver. And examining copy trading is one outgrowth of that question. The paper makes 2 contributions. First, it offers an explanation for the rise of copy trading, and it shows that copy trading is responding to a growing sense of distrust in traditional financial institutions, including in traditional financial intermediaries, and a growing sense that traditional institutions will not be sufficient to grow wealth. So copy trading, I think, is so powerful, or the message is so powerful, because it potentially offers a way for ordinary investors to kind of be on the inside and be in the club and to tap into the same knowledge and expertise that these, for lack of a better word, insiders have. But the second contribution is to show that what is really happening under the hood is that copy trading is just creating this army of shadow intermediaries where unregulated people are able to act as financial advisors or money managers without kind of the traditional guardrails around financial institutions. Financial intermediaries are heavily regulated, and I think for good reason. If somebody's going to manage my money or if somebody's going to give me financial advice, I want this person to be qualified and I want this person to be regulated. But copy trading allows pretty much anybody to become de facto one of these people, to become essentially a money manager or a portfolio manager or an investment advisor. And in doing so, I think the big risk is that it can shift, especially retail investment, away from these at least regulated traditional intermediaries towards unregulated intermediaries. And that's not to say there aren't problems with the traditional intermediaries. There are well-documented, well-known, long-standing problems, conflicts of interests, issues with fraud and manipulation, lack of transparency, lack of qualifications. However, I think copy trading worsens many of these problems without meaningfully improving the investment experience. And that's what makes me question a lot of the promises that copy trading makes. Leaders on copy trading platforms range from Wall Street titans to hedge fund managers to politicians to people who have followings on social media, finfluencers, as I've called them in other work, financial influencers, as well as ordinary investors who don't otherwise have followings on social media, but who can go onto these platforms and open portfolios, start trading, and accumulate copiers on any given platform. Herding behavior refers to the phenomenon where an individual just does what everybody else does, where they do what the group does or what the herd does instead of actually making an independent decision on their own behalf. And I think one really important thing for investors to remember, especially in this moment in time, is that somebody's risk profile, somebody's financial goals, all of that is a very individual, personalized aspect or characteristic for each individual investor. And part of the job of a good financial advisor or a good money manager is to take that into account when giving financial advice or when managing somebody's money. And I think it's important to remember, again, that your risk profile is your own. So whatever is happening on social media or whatever is the most popular new way to invest doesn't necessarily mean it is sensible for your own particular financial goals. And I think that's really important, especially because social media can really amplify, I think, perceived success stories of some of these alternative ways to invest. I suspect that a focus on ethics can improve the behavior of some of the actors in this space, but I also suspect that in order to really capture the behavior of everybody, legal intervention or regulatory intervention will most likely be necessary. And the paper explores a number of potential interventions, ranging from treating these platforms and these leaders as investment advisors and imposing fiduciary duties, to thinking about their trades as recommendations under, for example, regulation best interest, to changing compensation schemes and improving transparency. But ultimately, I think the most important thing is to be clear-eyed about what copy trading really is. And specifically, if this is really just financial advice masquerading as something else, we should regulate it as financial advice. I'm particularly interested in ways that information is created and disseminated in stock markets. I think the securities laws were built and developed around a rather narrow definition of information, sort of financially salient information that is material or significant to a reasonable investor, most commonly conceived of as a particularly rational investor. And I think especially with social media, increasing power of retail investors, a lot of that will need to be re-examined as we move forward and think about what kind of securities laws are best given the changing information and investing landscape.